good to see you. I was wondering with all those parties if you would be here, but yes.
Good morning, everybody. Right, I think we're going to kick off. I think most people know that the people on stage, but if we could, let's just start at the end. Let's just do a quick introduction, remind everybody who is here. Danny, just quickly, what you're up to.
Hi, Danny Reimer with Index Ventures. We do a lot of venture capital activity in Europe, in the US and Israel. I actually moved in August of last year to San Francisco to open our San Francisco office, but the heart of the firm is actually in London.
And just quickly, while we're starting, why don't we kick off with also deal of the year and investment of the year? It can be your investment, can't be your deal.
Deal of the year. Well, I mean, clearly Zoopla DMGT. I mean, that's clear. I mean, Johnny did an amazing job there. Let's see. In terms of, well, we announced Code Academy yesterday, which we were pretty excited about. There is one company that we discovered, which is not really well known in Europe yet, but we're pretty excited in, called Nasty Gal. Don't go to Nasty Girl, okay? Nasty Gal. And Nasty Gal is a fashion e-commerce company that was started by this 25-year-old merchant of vintage clothing on eBay 3 years ago. And she decided to then migrate and sell new clothes on her site, Nasty Gal. And fast forward 3 years, she did 30 million in sales and 5 million in profit without any venture backing. So that's pretty worth mentioning, I think.
Fantastic. Mike.
Michael Marquez. I'm one of the co-founders of Code Advisors, which is a full-service investment bank. We do M&A advisory, private placements, and IPOs. And then I also co-founded Murado Ventures, which is a seed stage venture fund. So as far as deals of the year, or deal of the year, it's tough for me to narrow it down to just one, so I'll mention the two because they were the most recent. I had the fortunate opportunity to work with Buddy Media on their sale to Salesforce, and then Face.com to Facebook, and so those are both two really exciting opportunities.
Roberto.
Hi guys, sorry. My name is Roberto Bonanzinga, and I'm a partner at Boulderton Capital. It's a firm here based in Europe. We started in 2000 as a benchmark in Europe. Today we have about $2 billion under management, and prominently and mostly all our investment activities in Europe, about, I would say, 25% outside of Europe, where majority of that happens in, actually in the US and few in China. You know, in terms of deal of the year, it's always difficult to say because I would say we have been very attracted in the last 15, 18 months by the world of commerce that we really pioneered in, I think, 2000 and 2002, when we did a small investment in a fashion company called Yux, actually out of Italy. At the time in which fashion was not very fashionable, and we took the company public actually in the Italian stock exchange, and is doing very well. So most generally, that is a type of segment that we like it right now, and we like the level of disruption that is happening in that sector.
So Jeff Claviers of Tech VC, firm based in San Francisco. We do a lot of early stage investing out of a $55 million seed fund we raised last year. The three categories that are the most interesting to us are next-gen commerce, SaaS, and mobility. 100% of our activities is in the US, but we have a couple of deals in Europe as well, which we're pretty excited about. Recently, we announced Blink and Farmeron. I think the deal of the year would have to be Fab. They were on stage yesterday. Bradford and Jason shared a bit of their growth, which has been fascinating. We invested about a year and 3 months ago, and it's just been crazy to see how massive they've become as an operation.
Thank you, guys. Danny, looking at you, I mean, one of the obvious topics at the moment is of the IPOs for internet companies. Facebook, Morgan Stanley seem to be buying up quite a lot of stock at the moment, so the share price has gone back up a little bit. But I think it's still seen as fairly catastrophic. You look at Facebook, Groupon, Zynga, etc. The public markets have not given, I think, the market generally confidence that the IPO is a good exit for these fast-growing companies. We've seen an explosion in valuations in the sort of the pre-IPO deals. Mike, you guys have been working with companies like Spotify, which have achieved tremendous growth in valuations achieved pre-exit. VCs are, in terms of overall returns, are in the doldrums at the moment. If you look at it as an investment case, it's not a great story in terms of investing in venture capital. Danny, if you're the entrepreneur today and you're looking at trying to look over the sort of the next 10 years of strategizing about how to optimize your balance sheet, optimize the capital structure, what are the pitfalls that we've seen now in terms of exits, in terms of how you bring investors on, et cetera, and what would your advice be, stroke reflections be, as we look around pretty extraordinary times?
Wow, that was very eloquent for 9 o'clock in the morning. Let me see what I can come up with here. I mean, I think that what you've described is absolutely fair in a lot of ways. I think we have to separate, obviously, the fundamentals of companies from the way that they perform and how they were actually taken public. I guess if I were to provide sort of my perspective to entrepreneurs, a couple of things. One is, don't try and reinvent the wheel in everything you do. Actually, Wall Street works quite well, and the stock market is a pretty good system. It's a pretty good marketplace that's been worked on for many years. So don't try and reinvent the system. Stick to your core business and your core capabilities rather than try and disrupt and reinvent everything that you touch, which I think is part of what's happened with a number of these IPOs, is sort of trying to take that disruptive, revolutionary, radical approach to a business and apply it to anything that is touched, and it has clearly hit a glass ceiling. Second of all, obviously venture capital has always been the same. Most of the performance is actually very concentrated in very few firms. And I would encourage entrepreneurs to do their homework and have a look at what the performance of those different VCs have been over the years, and what the chemistry of the partnership is, and what that relationship is going to be with whatever partner you choose to work with, given that it's really a very long-term marriage, and that it's much more of a partnership long-term. So those would be my primary recommendations. Stick to what you do best. Don't try and reinvent everything, and be very, very aware of the fact that venture capital is a pretty well-known and it's an apprentice-like service that has to really be evaluated based on chemistry and performance in previous years.
And Mike, I mean, you help a number of companies go through this process of raising, not necessarily at the venture round, but certainly as they get into the growth stages. When you reflect on the makeup of their shareholder register, a lot of the fast-growing companies is almost a collection of bumper stickers of the good and the great of the venture capital. They seem to be getting into their shareholder register at an early stage. Do you think that's a good thing, or do you think that as companies do go through that stage, you're better off having one or two partners rather than what I think we're seeing recently, which is a trend of trying to collect the top 4 or 5 brands in the venture capital arena?
Yeah, no, I would definitely caution against the bumper sticker collection approach. The one thing that I would say, though, and just to echo Danny's comments as well, is that it really is it's a process on both sides, both on the venture capital side and on the company side, and making sure that there's a good fit there. And there's a good fit through various stages of your company's life cycle, right? There's early stage fit where you get a lot of help from your VC through business development relationships or strategic advisory work and things like that. And that evolves over time. That same VC may be very helpful at the early formations of your company, but then as you grow through later stages of your company, you may be looking for crossover funds, or funds that, as you start to think about going public, that can hold on to your stock kind of post-IPO. That's obviously important as well. And there's a various makeup of your capitalization structure with your shareholders that I think that you need to think through all those stages. And I think that you need to approach it much in the same way that you think about bringing on, employees, and much in the same way that you think about partners through your business. This is a partnership, and through all of those phases, think about who is going to be the most valuable to you and your business.
And Roberto, when you look at that in terms of your businesses, when you're looking at the European and US markets, are you looking now to take some of your businesses public in the US versus Europe? Do you think there's a big European-US divide?
So, look, we have been operating between the two markets basically since inception in two orders of magnitude. On the side of the company building process, so we actually had some of our experience has been a lot of some of our European business actually helped them to move to the US. Not so much because of the exit, but at the very beginning, just also because of the company building process. It just was making sense for the growth and the type of business the business had to be in the US. So that's our first dimension. As far as exit is concerned, the beautiful thing is the market is more and more global. So the truth is, it really depends. It also depends on, where is the core competency of the business, and most of the business, where do they happen, right? There are no doubts. I mean, I don't think I'm saying anything, that is very new here, saying that, the NASDAQ is a more liquid market than any other market we have across Europe. But for instance, we were both investors with Danny Index at Betfair. It was making tons of sense taking it public here, right? In some cases, it makes more sense there. The only point I want to add is on the discussion we were having about, the entrepreneur selecting the VC, that I'm completely 100% in agreement with all the statements. I just want to add one. People sometimes forget about the perspective. I really strongly recommend the entrepreneurs to choose the VC that also they think is going to work the most. I mean, hard work, it's not only for the entrepreneurs, it can be also for the VCs. And people that work hard, they usually do for you more.
But why, Jeff, I mean, you've all been successful investors in a number of companies that have also gone public. Danny, just in terms of reflections, you've also been very good at people waking up the next day and realizing you've sold a business without a process which anybody's sort of known about. And arguably, I think there's a trend back towards that sort of process. But why are the venture capitalists not beating up the bankers more to make sure that there is a sustainable, successful public company that emerges from the IPOs? Because certainly if you look back on the last year, it's very difficult to look at a company which is happily public after going through the process, Facebook possibly being the combination of the worst aspects of how that relationship between company and banker operates. But you guys also have a responsibility to make sure that those IPO processes go well. To date, over the last year or so, we're not seeing many examples of where that guidance possibly has been successfully achieved.
Well, we don't have. Well, we were investors in Groupon, but we were not involved in the process because we tend to invest very, very early, and therefore it's up to more the later stage guys to actually make those decisions. I think that on the enterprise IT side of the house, there have been quite a few IPOs. I think Splunk has been doing pretty well. LinkedIn was under-optimized for the company, but the market position has been actually holding pretty well. So the question is, how much should you leave to the market and allow for a pop the first day and then throughout the first few weeks and months of the IPO process? Or should you actually try and optimize the way Facebook optimized it? Because they got their 16 billion, and then the whole market sort of imploded. So it's actually tricky to figure out what is the right position to take. What's clear is that the market was expecting so much from the Facebook IPO that we're now, and the most common reference for this has been a clusterfuck, which is actually not a great label, is figuring out what happens now. And to me, I think it's a wake-up call to the entire food chain that the sky is not the limit. And whatever you price your companies at, whether it's early stage, Series A, or growth stage, has to be sustainable. And to be honest, I think this is something that I almost welcome, because we've had a bit of a lunacy around valuations at different stages, and the best valuation, the highest valuation, is not always the best.
Mike, I mean, companies like Spotify we talked about earlier were growing phenomenally well. Do you think when people are now looking at those pre-IPO rounds, with hindsight of the Groupons, the Facebooks, etc., people are going to scale back and be a little bit more cautious about doing those pre-IPO rounds at such high valuations and possibly looking at IPOs a little bit earlier?
Yeah, that's a great point. I definitely think that as you look at just over time and more recently the valuations of later stage companies and what those have risen to on the hopes of, kind of what the public company valuations would become, I definitely think, to Jeff's point as well, that there is a little bit more of a rationalization around what those valuations could be. We definitely are seeing companies that are staying private longer, so you're seeing higher valuations because of that. But then we're also seeing, the expectations that this could grow larger, and you're not seeing as much of that based on the public market performance. And so I definitely think that, great companies will still be able to command great valuations, and I think that, companies that we're hoping to get, kind of more of a, drafting off of that, I think will struggle.
Yeah, I mean, I agree with what's been said. I mean, I do think that the folks at DST, when they entered the market, they did transform this market in making venture capital, which was a cottage industry, into really an asset class, and being less valuation sensitive and being less security sensitive has had a rippling effect in combination with some true successes of the businesses, very different from the 2000s, where there's a mass adoption of these businesses in combination with secondary capabilities of selling on second market, et cetera. So there are some pretty important tectonic shifts that have happened in our industry. But that being said, we've done, there have been late stage rounds done for Viagogo, Etsy, and Sonos recently, and in every case, I think that while they're in relative terms nosebleed valuations to what they would have been, they're pretty justified given the incredible strength of these businesses. And so it's not as simple as sort of thinking, well, it was a good period then, it's no longer a period now, and the companies that are being shoved down people's throats are probably not ones that you want to invest in, so take a holiday for the rest of the year. There are transformational businesses being built very, very quickly, as Jeff mentioned, with Fab, which is not one of our investments, but you can witness the type of growth, or Pinterest, which, again, regretfully, we can carry on with this sort of shrink list session for me. But anyway, these businesses are really transforming very, very quickly.
I guess the challenge is when you invest as a venture capitalist, you bet the farm on the growth, as opposed to figuring out, what the multiples are going to be in the public market, and that's where it actually breaks. Because when people sort of bought Zynga at $14, they were clearly expecting that the market would definitely price them much higher, and it's at 6.
If I can, just a point I would like to make that I think is a bit of a more general issue that actually I think goes through all the stage of the company building process, from the day of conception to the day of exit, which I think is a key word for all of us, all the actors into this ecosystem that maybe we should pay more attention, is the word sustainability. We are here to build a great, fastest growing business that are sustainable. And they are sustainable, when you start the product, with virality, all the level of distribution, you can grow things super fast, but they are just not sustainable in the long term. And this concept of sustainability goes, into all the stage of the company building process, last and not least, at the time of the exit. So if I have, one key comment for all of us in this room to think about is, let's ensure that we build a very fast-growing, sustainable business.
I think sustainability is absolutely true, and I think that the good businesses are the ones where you do fundamentally see that sustainability, and LinkedIn is a classic example of where that gradual growth into their valuation, and a new investor base has emerged as a huge success story. Danny, therefore, when you're looking at your portfolio now and you're looking at the funds which you're beginning to raise, do you think you're going to see an increase in M&A being an exit, or the IPO markets, or is it going to be much the same as you've seen over the last 5-10 years?
Yeah, so we announced earlier this week.
Sorry, microphone a little bit closer.
Sorry. So we invested we announced earlier this week the 6th venture fund being raised. So we kept it the same size of 350 million euros, geared towards very early stage investing. And so we're trying to stick to our knitting and continue to do what we have been doing. We've also been very public. Actually, one of my partners wrote a blog about this, that we really are encouraging more companies to go public in Europe, which is 2/3 of our investing is in Europe, and that we really want there to be an IPO market for Europe. It has massive rippling effects on the ecosystem, and that means an effort from underwriters and an effort from institutional investors and an effort from VCs to really try and build much more of an ecosystem for taking companies public in Europe.
And the government message for George Osborne, what should they be doing?
Well, I sort of, they should encourage laissez-faire as much as possible.
So Vince Cable's views on how boardrooms should be managed is not relevant to our portfolio companies. Guys, we're coming towards the end. Let's, just for a little bit of fun, Facebook and Zynga, are you sellers or buyers, Danny?
Why does it always start with me? So Facebook, we invested in 2008. Don't really deserve any credit because we've done absolutely nothing for the company to be successful, but it was a good trade, and we still own it today. And in the case of Zynga, we're very long on the market. So, and Zynga's in a very good position.
And King.com has been one of the great rebirths of all time.
Correct, correct. So we're really proud of those guys. And so we do believe that there's a huge amount of opportunity in that space.
So I think that we're just scratching the surface on what Facebook and Zynga can do, and in the long term, I'm a buyer of both.
I do have a positive outlook on both, and I also think that a lot of what they have been doing has been quite transformational to the industry in terms of next generation gaming companies, in terms of the social layer across the internet. We invested 2.5 years ago in a small company in Berlin called Vuga, where there were 4 employees in the company, right? Today is a 300 people company, and in the social media space, they've been basically generating a completely new opportunity. So I think all of us should be just super excited about everything is happening and the potentials.
So agreed on the long-term outlook on Facebook, which is a massive, a really very impressive company that will grow into its valuation and will end up over $100 billion in valuations and so forth. And we still hold on them after having sold the company to them. On gaming, we've actually stopped investing in gaming about a year ago because we think that there is still a lot to be done and learned, but we need to find new tricks, new approaches, because a lot of the current gaming companies, while very successful, are using the same playbook, and so we're looking more at mobile gaming and new kinds of opportunities.
Great, ladies and gentlemen, thank you very much this morning. I always end, having done this panel, feeling more positive about where the world is going, despite what may be going on in the real world around us. But thank you very much, and I hope you have a good rest of the day.